Aditya and the Association of International Wealth Management of India to invite me to this first international conference for family offices in India. It's nice always to have something which is first, and it's great to have this family office here in the Shangri-La. The presentation that I'm going to do is about core satellite strategies. Who does not know anything about core satellite strategies? Who does know? All of you know everything about core satellite strategies? Yes? I could go. Okay, that's great. That's why Aditya has invited me. The second part, or another part, is we have developed in our company indices. This is a kind of a global asset allocation indices. We do use it for benchmarks of portfolios and as well for the basis for our classic core strategies. More about that later. Part of what I'm going to present you is as well a short overview on the strategies. Afterwards, I would like to show you some praxis, how you can use instruments in these strategies. And actually, to close the presentation, I would like to I would show you some opportunities how you and we, our company, could find some synergies and opportunities of a cooperation. Maybe important at the beginning is that I'm here until Friday, Saturday morning, and if somebody has not understood all of what I'm going to present, I'm available for meetings at your offices or in the hotel the next 3 days. I will be very pleased to have an hour with you to discuss and to exchange information on strategies, on your strategies, just to know about each other and to know the markets each other. So, I'm very sorry I have got a cold. Where does the core satellite strategies are coming from? Maybe you know in the later 90s, there were 3 big American companies. The largest companies, the largest asset managers in the world. They were Barclays, Fidelity, State Street. Not all of them you know. Well, probably you know. But why they were so big? Because they were all invested in passive managed products. We know them today as ETFs, exchange traded products, but actually they have invested the money into indices. What does it mean and why they have done it? They have done it because you don't believe it, maybe, but out of 4 active managers, only 1 is beating the benchmark mid or long term. I know there are some active manager or some portfolio manager here in this room, and every one of you thinks I'm the one who is beating the benchmark. But I tell you, out of 4 active managers, only 1 is beating the benchmark, which means the index. And that's why indexing and investing in indices is quite a good thing. And this is what which is the basic, the classic strategy. Sorry, this is the agenda. This is, can you see that? Okay. This is the core of a classic core satellite strategies. The investment should be somehow 2/3 in the core and 1/3 in satellites. The core is the strategy that you are investing in your basic strategies. If you are a defensive manager, you will invest more in income. If you are balanced or if you are growth manager, you are more investing in such strategies. The best that you can do are using indices for this or ETFs. So as we see, passively managed portfolios focusing on and covering the basic strategy of your portfolio. What are we doing with the other third? The third, we do invest to pick out the pearls in the market. We are going to search the one fund manager who is beating the benchmark, which is quite competitive. How can we find this one manager? What could be the best opportunity? There are several sectors where we can find them. Our company has defined 4 sectors: alternative investment, commodity investments, CTAs, also commodity trading advisors sector, and sustainable and new energies. The last sector is not that much beating the index because very often they are long only, but what that makes them interesting is the way how they are investing, and very often green funds such that, or sustainable or renewable energies get money from the government, and that's why they beat an index. They get money from the government because they are investing in renewable energies, in clean tech, in different areas. But what is important for these satellite products? Important that they are alpha generating. Alpha generating means the overperformance over the expected average performance on the core. How you get this on a mid to long-term basis? We have developed out of that the strategy that you should invest in none or few correlation products to traditional markets. You should develop products which are not correlating to the equity markets, to the interest markets, to the whatever bond, real estate, whatever, which are in a niche and are acting in a niche, which are senior and experienced in that niche, and have a steady performance done over a while. This is what we are looking for. Which are the benefits of a core satellite strategies? The benefits for sure are that the core is very, very large diversified. With ETFs, you can invest in globally, and you can act regionally. Besides, you can buy an index, an ETF of a global index. You can buy an ETF of a sector. You can buy whatever one. You get to buy into passive management. This is liquid, daily liquid. You can buy tomorrow. You can change your strategy tomorrow. The core is your strategy, and you're acting towards your strategy. So you can change it every day, because ETFs are likely so liquid that you can change them every day. Saying that, there is also, and this is the evolution of the core satellite strategies, if you're going back to what I said, to the largest asset manager companies, why are Barclays and Fidelity and State Street not anymore the largest asset managers? If they have done it so well and the costs are low and they have all been asset managers and they have beaten the active managers. Why? Because the last 12 years, We had several equity years, we have economic crisis, we have very, very heavy years with downgoing equity markets. So, and this is the evolution to the core satellite, that the main risk of this strategy is its exposure to the market. What does it mean? If you buy an index, you buy the market. And that means that if the market is going up, you're laughing. If the market is going down, it's the opposite. And this is the main risk of this strategy. And so I'm coming actually to the alternative of such a strategy. Before going to the alternative, have you understood this? So we invest in a classic core satellite strategy. The passive is the strategy that you are minded. Your strategic position, if it is global and balanced, then you have as much income and as much growth products. If you're a growth manager, you have maybe 80% in growth products and 20% in income products. But the core is passively managed. You're always 100% exposed to the market. And then the satellites, as said, the satellites are non-correlated. That would be the best. Non-correlated to traditional markets, that they will generate alpha. Alpha is the most wanted and the most difficult to find. Oh, stop it. Mm-hmm. So, the core classic satellites, the classic core satellite strategies have also an alternative style. I would say we are among the first in Europe who have probably developed this kind of style, because out of the past 5 years, we said, okay, somehow we should not get too much exposure to the markets, which means what could we change? We asked ourselves, what could we change in